Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters.
I'm Pat McClain.
I'm Scott Hansen, and we're going to do something a little different. We're going to get right to the calls today.
Yes, we've been reading some of the reviews, and you said take more calls.
Yeah, so we are going to start off talking with Mike.
Hi, guys. How you doing today?
Good. How you doing, Mike?
I'm good.
Good.
Listen to you guys every week.
Thank
Enjoy
you.
your show.
Thank you.
Yeah.
I appreciate that.
I have also talked to one of your advisors in the Denver area, and I just haven't made the leap yet.
All
Okay,
right.
well,
But here's my question. I'm working with an advisor I've been with for quite a while, and we had some money just sitting in these buffered accounts with Schwab, about $360,000, and it wasn't doing much, and I wanted some income from that cash, so he put me into yield notes, and I've done some research on it, but you guys have a way of explaining things simply, and I'd like the fifth grade explanation of how yield notes work.
well, why? Before we go there, why don't you tell us what your interpretation, either from what you have researched or what the advisor, or depending upon how they're being compensated, commissioned salesperson is describing them.
Okay. I have 4 ETFs that I'm in, and they have a bottom and a top. The bottom is if it loses more than 70%, and there's 4 of these in this trust fund.
And what are they tied to? What's the underlying index that they're?
So the one is QQQ, which is technology, IWM, which is Russell 2000, TLT, which is bonds, and utilities, which is XLU. So those 4 ETFs are tied to a 70%. If you lose 70% or it goes up 1% or 1 cent from what we paid it, then they're what they call, let me see, where did I put that? Not callable, but issuer called notes.
Okay.
So
They're non-callable?
I believe they're not. They're issued caller. They're issuer called notes.
They can be called by the issuer.
Yeah.
Correct. So for the last, I don't know, 7, 8, 9 months, I've been collecting about $3,300 a month off this $360,000 bucket of money, and
Yeah, good yield.
It's a good yield, and I'm like, and the principal hasn't gone down much. I mean, it's gone down a little bit, but not much. And what happens is if one of those ETFs goes above 1 cent or below 70%, then the bank can call the note and we start over.
Okay.
And we take that principal and decide what we do next.
When you said it hasn't gone down by much,
Yep.
what dollar amount has it gone
Yeah, what
down?
happened when the Liberation Day, the tariff Liberation Day was announced?
Didn't go down much. I watch it every week. I'm probably a nerd like that, but right now the cost basis is about $355,000.
Okay,
So the value today is $355.
No, the cost
Yeah,
is $360 today.
Yeah, that's correct.
So I remember when I first started in this industry, my manager had a plaque on his desk, Tinstafel. There is no such thing as a free lunch.
Right.
So
I
I've always
That's why I'm
remembered that
calling you
in
guys.
any
Okay.
sort of an investment product that has what appears to be an above average return, I question, like, how can it have above average return?
Right.
Where is the underlying risk in this investment? Because if this were, you're at 10, 11% yield or whatever, 12% yield, if this was without any risk,
It's about
people would bid up the price, and the next thing you know, the yield would be the same thing as treasuries. So the risk you've got in here is that the underlying index, as long as the index stays within a band, and I don't know exactly how these particular ETFs are structured, but as long as the index stays within some certain band, you're on easy street. But if we have something where the index goes below some floors, that's where it starts triggering some losses.
Right.
Let me ask you this. So how much money do you have with this other advisor now?
Let's see. Well, my total portfolio is about 3.6 million, but it's not all with him.
Okay.
And that's another story, and that's why I was looking for other.
And how much income are you trying to generate?
So we generate. I generate about 42,000. I'm retired. I'm 67. Wife's 65. 42,000 in Social Security, 20,000 and another financial loan that I've loaned to somebody for a business that I've been getting paid from. I have an equity or an annuity that was annuitized that pays about $7,800 a year, and then this particular yield notes are paying us about 68. Let's see, 39,000.
Yeah,
39,000 a year. So it's a big piece of our income. Our income is we're spending at about 140,000 a year. And our income's at about 139 with this yield note in income.
Yeah, it just
but
seems.
I also realize that income could stop.
Yeah, it seems strange to me is that this is where they went to generate income.
Well,
there's other things within the portfolio that are coming to bear that are going to generate substantial income, but I don't want to get into a lot of that detail now. That's something I'd definitely talk to, one of your advisors about.
You believe they are going to come to bear?
I do. Yeah, I do. I think I do. I also have about $1.2 million in an annuity that is going to mature in about 3 years, and I've been looking at that to think, this was a waste of money. Yes, the people that I'm with sold it to me. Yes, they made a bunch of money on it. And I'm not making a whole lot.
They sold. So you said, I've got some cash, and they said, what can we sell Mike? Mike's interested in yield. Let's give him a portfolio that's got yield so good that he's like, how can I pass up on this yield?
Yeah.
There's an old saying on Wall Street, when the ducks quack, feed them.
If you show an interest, they're going to throw you some bread.
And look, the financial industry is no different than other industries in that they want to manufacture products that people want to buy. They have some sales structures. They've got wholesaling distribution. They have marketing teams that come up with the proper names, right? So, I don't personally own any of these.
My view of this is you've made this much, much more complicated, or whoever's selling this stuff to you made it much, much more complicated than you actually need it to be. So of that 3.6 million, how much is in IRAs?
384,000.
Oh, wow.
So most of it's cash because we had a business that we sold.
Okay.
Back in 17. Yeah.
And do they have a tax efficiency overlay on top of this portfolio?
No.
Okay. So
I do not.
I could make an argument right now that look, we could turn around and start a 3% distribution out of this total account, which I think actually probably.
How old are you, Mike?
67.
Okay.
67.
Makes a lot of sense to start a 3% distribution and lay a tax overlay on top of this and sell off individual holdings at a capital gains rate, put all the bonds inside the IRA. This is
one of these ETFs is going to blow up. It's going to lose 70% one day.
Scott, but this is just completely tax inefficient. I mean, there's no I don't even know how to explain it. There's no view of your after-tax return at all. It's just return. And all you're really interested in is the money you can spend, right?
You're interested in maintaining your lifestyle, making sure that you can maintain that the rest of your life with inflation adjustments, and having your net worth grow up as much as possible and maintain your lifestyle. That's your number one concern, I would imagine.
Yeah, that's right. And I do have more money in fixed income than I should. I should have more in equities, and I don't.
I would call these are more equity equivalents. These are riskier than equities. I mean, I haven't seen them. I don't know the exact ETF, but anything that's paying out 11% yield, if the underlying bonds are paying 4 or 5 or even 6, where's that extra yield coming from? They're selling options to generate that income,
which is what giving away the upside.
All three of these ETFs are up. Other than the only one that's down is the bond ETF.
Okay.
That's the only one. It's down, $9.
You've owned them for how long?
I bought them in October of 24.
Okay, great. They're up. Super.
Yeah,
but you're not going to die in a year or two. You're going to die in 25 years, or your spouse will die in 25 years. If we look at an actuarial table, you're acting like a short-term investor with a high risk profile on parts of your portfolio.
The
only way to really look at I don't have these notes.
Question.
And I have my patience to do in-depth analysis is not there, so I rely upon a team. But what this should go through is a screen that says what happens to these in a variety of different markets.
Right.
Right. What happens
if my question? Are yield notes they're high risk?
There's no such thing as a free lunch. Where is that yield coming from? They are selling options on this portfolio.
And you've got the downside.
Yeah.
Yeah. So and if you read through it, the perspectives, there's some floor. If these indexes pop through that floor, I don't know how big the downturn can be, but it can be substantial.
Well, I think it would be based on any of these ETFs falling 30%. That's where they have to fall, 30%.
Well, I don't know that.
Well, that's what he believes that.
Okay.
Well, that's happened.
No, that's what they have to do.
Okay.
That's what they have to do.
And then what happens to and then it drops 70%?
If it drops 30%, then 31%, then I get my principal back, probably less than 30%. If it can, 3 of the 4 are up. If the 4th one goes up, the bank calls the note and we get our principal back and we start over something else.
Yeah.
Mike, this comes back to me. It's not manna from heaven. Like, where is the extra yield coming from?
Mike, what kind of business did you sell?
I was in the restaurant business for 40 plus years.
Wow. Okay. A rough, tough business, right? Without question.
Very tough.
Very tough business. You didn't go in with a theme selling tacos one day, hamburgers the next, Greek food the third day, right? You had a unified concept going into a particular theme or thematic restaurant.
That's
right. Right? Your portfolio is you've got tacos over here in this corner. You're like a food court. That's what your portfolio looks like to me. There's no overall arching.
And you're asking like, hey,
strategy.
what do you think about these sausages?
Yeah, and I'm like, well, how long are the sausages going to stay on the menu?
What's even in these sausages?
Well, the sausages.
Are they going to kill you? What kind of garbage are they?
We've taken the analogy too far, but you've view this, your portfolio. You have to have a thesis behind it as to what you're trying to achieve. You're not just picking and pulling concepts out of the thin air. And so the first thing you want to do is start at the very beginning, which is how much risk am I willing to take in a portfolio for a given rate of return over a period of time?
And modeling, whether you use Monte Carlo simulation or some other modeling, to what happens to this portfolio during severe downturns? Because look, in the last 25 years, we've had twice where the stock market's fallen about 50%. One would expect in the next 25 years, we'll have 2 other times like that.
But Scott, that isn't the weirdest thing about it. The weirdest thing is that we're reaching for yield on this with tons of risk.
Yeah, this is the guy, his advisor got a commission selling him annuity, probably got a commission selling him these.
Well, how does your advisor get paid?
He gets paid based on the portfolio's growth or value. Actually, the value of the portfolio.
Assets under management fee.
Yes.
Except for that annuity.
So correct, because they already got their money on that.
Okay. Okay. I
They
just
get a percentage of what they're managing.
Got
in
it.
terms of value.
Got it. There's no underlying thesis to your portfolio whatsoever. That's
Okay.
what the problem is. If you don't have an investment policy statement, there's no direction behind it. There's parts of this and this. There's no tax efficiency in it whatsoever. Zero. I would make an argument that if you were going to do these sorts of things, you would do it in your IRA over that because of the yield
That's
on
right.
this. That's the argument I would make. But
Okay.
if you were to do it at all,
I totally agree with you, Pat. It's
it-
highly tax inefficient. 11% yield,
yeah. So
taxable yield.
So just take all the pieces and try to construct a portfolio that is weatherproof. Weatherproof doesn't mean that it's not going to go down in value. Weatherproof says that it's going to live until your dying day with an expected rate of return. And I think you should actually start spending more money, quite frankly. I mean, you've got $3.6 million. Part of it is actually in an annuity that's being paid out. I think that you can probably tolerate a little bit more pressure on this portfolio for income and then build it.
And you're going to want to also structure what's this annuity that you've got. You call it maturing. I don't know what that means. I think it means that their surrender charges are gone. But
Well, we turned on one annuity that we had, and we had 2 others that are maturing in 3 years.
What does
through
maturing?
Allianz.
What does maturing mean? Does it
So
mean
it's
the surrender charge comes off?
It'll you start it's a 10-year contract, and once the 10 years hit, you turn on the income.
You can turn on the
So-
income.
You can, and my decision now is I don't know if I want to keep the money in with Allianz. I think I might take the money out at the 3-year mark, or I take it out now. I've done the math. I could probably invest it in something, something else through a good advisor that is going to make me 4, 5, 6%.
the challenge you've got is the tax. Again, where tax point, Pat's point, it's the tax. All the growth in there is going to be taxed as ordinary income.
But that doesn't mean you can't move it into a low cost fee only annuity.
That's right.
Right? Which, by the way, they were pretty uncommon 10 years ago. You can find them very easily, low cost.
an advisor manages just like another portfolio.
And the advisor manages like another.
It still has that tax overlay that you may or may not want longer term.
Yes, or you might want to do a variable annuitization on it.
Yeah,
That's right.
Right? There's nothing wrong with that.
All right, guys.
You've
got a lot of options.
You're not getting good advice.
Fortunately, this is only 10% of your portfolio.
That's good.
I wouldn't own these.
Correct. Okay.
That's
what I wanted to know. That's kind of where.
But by the way, Mike,
I was trying to get a.
Nice job.
Go ahead.
you did a great job saving.
Yep.
You did a great job saving.
Building your business.
And you did it.
I tell you what, though, it's this point of your life when it gets difficult to, take the money. Where do you invest it? Who do you invest it with? Who do you trust? It's like, you're right. I made a lot of money in the business of what I did for 4 years, and I knew what I was doing. And now it seems like all of a sudden I'm a dummy.
It's hard.
It is hard. It's not easy.
It's hard.
And you'll never be an expert, right? So it still comes down.
And I don't want to be.
I understand. You need to educate yourself enough so you kind of know what's going on and you know how to pick the right advisors and the people to trust.
Right.
But it really does come down to someone you really trust and having that relationship.
Exactly.
And it's not. It's when the times are easy. It's when the times are rough. When the financial markets are going poor.
It's hard. Yeah. It's and it's a good problem to have.
I think I'm going to go visit one of your guys here in the state and see where we're at.
There are lots and lots of firms out there. The problem for the average consumer is trying to figure out what's good and what's bad.
Yeah.
Right.
Yep.
It's difficult.
It all comes down to one thing. It comes down to trust, and you have to have the trust in the and have the confidence in the person you're with.
Well,
I think it's two things. It's that and a cohesive strategy. What is our long-term
Yeah.
strategy here?
yeah.
Yes.
Not just like, well, here's some products that'll work for you, but like, how does this all work together?
Yeah. So look for a competent firm, right?
I will.
All right, Mike, wish you
will.
well. Yeah, but you
Appreciate it,
you
guys.
did the
Thank
hard
you.
part. You accumulated the assets. So.
In a restaurant that probably has what's the failure rate in the restaurant industry? I'm going to guess it's 70%.
Pretty high. It's pretty high. Yeah.
Yeah.
I got out at the right time. I'll tell you that.
Well, you would have been. There's people that have been getting out of that industry for 30 years that say the same thing.
I never got in the business.
I didn't want to be in it during COVID. I didn't want to be in it during COVID.
Oh
you know what I
gosh,
mean?
yeah. What a nightmare.
Yeah, it's just a nightmare. So
I appreciate the call,
that
Mike.
probably would have killed me. Take care, guys.
All right. Yeah, it's amazing. I think about some of these restaurateurs that went through that period and like, holy smokes.
So I bicycle ride with a gentleman that ran 2 restaurants through COVID. Owned one and was the management team on the other, contract management. And we had lots of time to bike ride during COVID. And I'm just like, how's it going? And one of the biggest problems they had is when they reopened, even partially, is that the money that the government was paying the employees not to work caused them not to work.
They couldn't get people back.
You couldn't get people back. It was rough.
Right. Anyway, back. It's Wall Street will create any product you can imagine.
That's right.
And anytime you've got a payout, like whether it's monthly or quarterly payout, that is higher than what the market is paying, you need to ask yourself, where is that additional yield coming from? Is it coming from my principal? Sometimes we see that with real estate investment trusts. They've got a payout, but actually the principal value is declining. So we see that. Is it coming from principal? Is it becoming because there's some options that are being sold to generate that? And if that's the case, well, what's the trigger point where my assets are now going to get called away from me?
That's 100%.
And then what's my downside here?
So Scott,
there are times when these things might be appropriate as a piece of one portfolio managed within.
Typically over the short term. You have to have a reason behind it for the short term, because otherwise it puts a drag on the portfolio, which normal market cycles you can live through and not pay that insurance premium to sell these.
That's exactly right.
Right. So I pulled this article, just happened to pull this article from Jeff Sommer from the New York Times, and he talked about investing, but he said one of the ways it isn't easy to invest. First, much of the financial service industry is dedicated to incessantly selling new products and services, including advice intended to keep you buying and selling the latest new thing. That kind of behavior generates profits for asset managers and advice givers, but not necessarily for you.
That's why he just read that this week.
I read it last night.
Oh,
and I said,
what does that? Read that one more time.
It said
thinking about something different.
Why it's difficult to invest, by Jeff Sommer, New York Times. First, much of the financial service industry is dedicated to incessantly selling new products and services, including advice, intended to keep you buying and selling the latest new thing. That kind of behavior generates handsome profits for asset managers and advice givers, but not necessarily for you.
So one of the reasons you hear us talk about the importance of working with an independent advisor, look, the big Wall Street firms, I'm not going to pick out the names, you know the names, they manufacture this stuff.
They manufacture products.
So I'm going to pick a company. What's the difference? Because it's true. Like Merrill Lynch. Okay? Merrill Lynch has many lines of business.
Yeah.
One of the business lines is offering advice to clients, and they'll do some on a fee basis where they'll try to make sure the interests of the advisors are lined up with the clients. And so when the clients do better, they'll do better. That's part of the structure. But they also manufacture some products, things like this. May not these particular ones, but they have other financial instruments that they manufacture. Further, they are in the business of helping other companies raise capital by selling their bonds or their stocks. So They're going to some company and say, "Hey, we can raise $4 billion of bonds for you." Where do you think those bonds go?
To those Merrill Lynch, right?
I mean, that's partly, yeah.
They also are in the business of selling home loans and banking advice, and they're scored on it.
That's right.
So what's the point of
Your
actually
financial
having
advisor-
an advisor take money from your portfolio and pay off the home loan if they can get you to borrow the money from them?
Their pay grid, as they call it. To your point, Pat, they're scoring. I remember talking to one guy who says they have to have a certain amount of credit cards. They have to have people sign up every year. More loans, whether it's against the portfolio, security-backed lending, or it's a mortgage.
Really? I've heard about it, but I've never talked to anyone that you talked to a guy that had it.
Yeah.
Did he hate it?
You know the guy I talked to. Yes.
Oh, I've never talked to him about this. But imagine selling credit cards to clients. Holy smokes.
Pat, they got all kinds of benefits. You kidding me? Look at this. You can get a go on the cruise.
Okay.
You get free upgrades on the cruise.
Anyway,
And
but Scott, in all fairness, it's independent advisors. There's good ones and there's bad ones
for
too.
sure. And at Merrill Lynch, there's great advisors that say, "Hey, I don't care about your management. I'm serving my client. My client comes first. I'm going to ignore you and all that other garbage." For sure.
Yes.
For sure. And you can have an independent advisor who's a
dirtbag.
Yeah, correct. Or inept or both. All right, let's continue on. We're talking with Dave. Dave, you're with Allworth's Money Matters.
How come you guys never talk about options? Huh?
You want us to?
You remember that call?
Oh, yes. I know. This is
There are
bringing
things that I try to suppress, Dave. A lot of painful things in my childhood, and the call a couple weeks ago on the options.
Oh, I
Come
didn't
on,
know.
the options. I want to hear about the options.
I didn't know what
That's right. He was angry.
I couldn't figure out what his agenda was.
He was very angry. Yeah, he's not a happy man. No.
He's not. Well, you sound like a happy man, so you can spend all day on this call.
Well, hello, neighbors. I moved to the beautiful hills of El Dorado in 1997. So,
well, thanks.
Wow, you've been there a long time.
Long time. A lot of changes, but still a nice place.
I moved there in 1995, a couple years before you. El Dorado Hills, and I probably will die there.
Yeah.
So what can we do to help?
I have a couple questions about Roth conversions and asset allocation.
All right.
How old are you?
I'm 65. I'll be 66, and my spouse will be 65 in December.
Okay.
And I'm thinking of suspending my Social Security at full retirement age, and suspending my wife's. I started taking Social Security at 62, and that'll enhance my ability to do the Roth conversions before required.
I mean, you can suspend at any time.
Yeah, you don't have to wait till then.
Is that right?
Yeah.
Okay.
And so what's your income now?
Income now is Social Security between the two of us at $42,000. Pension that it has no COLA at $41,000. Dividends off my non-tax deferred, not qualified brokerage account of about $15,000. And then my wife has part-time work about $7,000 a year. That's about $105,000.
Okay.
And how much do you have in IRAs, 401ks?
In qualified IRAs, $3.3 million.
And how much money do you have outside
In
of
your brokerage, savings, CDs?
1.3.
And of the 1.3, how much of that is doesn't have a huge capital gain built up in it? How much could you withdraw without any taxes?
It's all capital gain mostly. Probably 80% capital gains.
Well, good for you.
Yeah, I started in 1987. Got my first job, and I got my first real job, and sat down and wrote a check to Vanguard and started every paycheck. I'd try to put $100.
Excellent.
That's how it works.
There's no, it's funny. There's no easy way.
That's how it works.
There's no easy way to accumulate
And then
assets.
as your income went up, it went to $200, then it went to $400, and then it went to $1,000.
If I got a bonus check, I didn't change my spending.
You went and bought a new Hummer.
No, I did not. So that's 4.6 million.
Yeah.
And the total asset allocation is 60-40, 60% equity, 40% bonds.
And are you taking any money from these IRAs right now?
Yeah, when I needed a new deck, yeah. When I got the front yard redone, yeah. But otherwise, we're pretty much living off them. Yeah. Sometimes, but not very much.
Why would you wouldn't, you can do plenty of Roth conversions without suspending the 401k.
I mean, the Social
Security.
You're forgetting something.
Oh, okay. We're going to talk about Medicare.
My affordable care handcuffs.
Oh, because you're
the golden handcuffs.
How long do you have the affordable care?
I retired at 53.
I know, but you're 65 now.
Right. I'm on Medicare, but my wife's not.
Okay, and when does she qualify? When does she come off?
The handcuffs come off in December this year.
And that's when she goes on Medicare.
Right.
Okay.
All
so
right,
you're not going to do
explain
anything
that. Let's explain that to the listeners real quick, Scott.
Let me say, over the 12 years, you know what that Affordable Care Act's been worth to me?
Yes, a lot.
How much?
They had
tell me.
$141,000.
250 to 300.
Holy smokes!
Lord.
Well, they had you in.
I had premiums of $2 a month.
They had you in mind when they designed the Affordable Care Act, Dave. That's what they were thinking.
Yeah, because so just for our listeners, the Affordable Care, it's based upon your income, not your assets.
And so what happens is that we do it all the time, right? Which is you spend down brokerage accounts or money in the bank.
Don't touch your retirement accounts for a period of time.
So anything that you can even actually take loans out and actually bridge you, and you can make an economic sense to actually do that.
Of course, yes.
Yeah,
even paying 7 or 8% loan cost.
Yes.
And quite frankly, I always, I kept my income low on what I told them it was, and then at the end of the year, we evened up, and I kept the money for the year. So
yeah. So once that comes off, let's talk about 2026, right?
Yeah. So that's why I haven't done the conversions, because for a while there was a cliff, and if my income went over, and I was paying, the premiums were $25,000 a year, and if I went over the cliff, then I owed them $25,000.
Yeah.
So
Yeah.
That's why I've not done.
But you just start the Roth conversions in 2026. I don't know if I would touch that Social Security.
That was my question.
Yeah,
I can suspend. And should I suspend my 41 or 42,000 in Social Security income?
I wouldn't.
Yeah.
Here's why. Look at this.
Yeah.
In 2033 or 2034, we're talking about 8-9 years from now. You want to talk about a cliff? There's a cliff in the Social Security. The way the current law is written on Social Security, when that trust fund goes negative, there's an automatic reduction of 24%
across the board.
Yeah.
But
that's why I took it at 62.
But it won't be across the board.
You've got 4.6 million. Right now, Obamacare is only looking at your income. They don't look at your assets.
That won't be the case.
Right.
And not only that, when you've got required minimum distributions, I don't care how good a job you do in Roth conversions, you're still going to have pretty substantial required minimum distributions. That's going to put your income at a high level. So I would not suspend.
I would actually keep the Social Security doing and start the Roth conversions in January.
Yeah.
Yep.
Okay.
Yeah, he's brilliant management.
Nice job.
It's funny. As a taxpayer, I hate hearing these things, but as an advisor, I love it. Right? So,
I didn't write.
Oh no! I totally look. We help people figure out how to drive trucks through little mouse holes.
We do it all.
No, I mean it's you know what quite frankly, I'm thrilled with my retirement. Everything's just wonderful, and it would have been tough without that. Without the Affordable Care Act.
Okay. I don't think anyone out there is feeling for you, Dave.
No?
So instead of
All right.
instead of 4.6, he would have 4.3
Yeah,
Right, look, there you go.
I don't think anyone out there is like, oh, poor Dave. Just telling
come
you.
on. Come on. Let's talk about options.
Okay, all right.
How about-
I wish
my
you
other
will.
question- My other question. one
Okay,
more.
quick.
It's just asset allocation. I'm 60-40. But 100% of the non-qualified is in equities. So that means about 50-50 in the qualified. Since I'm not planning to touch that qualified until required minimum distributions, I should be more aggressive there and bring the whole thing to 70-30 or?
It depends on, I mean, I'd model it through and say, all right, given these scenarios, my 4.6 is now worth 3.1. How am I going to react?
Versus, right?
Because you're not
not gonna-
65. You've got, odds are at least one of you are going to be alive at 90.
Right.
So you got a long time ahead of you.
Yeah.
And if you've got the stomach to withstand the ups and downs, it's not like you're having to pull 8% on this portfolio or something.
I could make an argument that you should keep it 60-40, and I could make an argument why it should be 90-10.
And it's easier
Yeah,
when the
me
market's
too.
been on fire and has done as well as it has the last 5 years to make an argument why you should increase your allocation.
Which is
more.
exactly
Yeah.
the counter argument that I would
Correct.
use. So
it's just 10-year money, right? The qualified part. So that's because I don't plan on touching it until my required minimum distribution.
yeah, understand, but you don't take it all out either. It's going to be there's money going to be there.
Yeah,
when
yeah.
the day you die.
30-year money.
Yeah, and it doesn't mean that you actually have to spend it when you take it out. We have plenty of clients that actually take required minimum distributions and send it right over to their brokerage account to reinvest tax efficiently.
Sure.
I mean, it's just so. Anyway, great talking with you, Dave. We gotta run now.
Yep.
Thank you.
Thanks,
Thanks,
Dave.
guys.
Glad you called.
Appreciate it.
Yep. Wish all of our clients were as friendly, as happy as
Dave.
Dave. Yeah.
All right, so we have a house call. These are, quite frankly, other than the chit chat, Scott, my favorite part of the show.
To someone we've given some advice to, and then
Yes.
hear what's happened.
And it's called the house call. And what we do is we follow up with someone we gave advice to, and we find out whether they took the advice, ignored the advice, took part of the advice.
Yeah.
We just follow up.
Yeah, and 2 weeks after Liberation Day, beautiful Liberation Day, the markets were highly volatile. We spoke with Ann and Patrick. They're not all with clients. They were nervous about what was going on. One of them wanted to sell. One of them didn't. Here's a clip from that original call.
We're both retired, have been for some time. My husband is going on 72. I just turned 70. And so recently, my husband has said to me that he would like to basically go all in to cash.
Well,
And
in the money market or
yeah, money market.
Yes. And
With,
how long have you been retired? How many years?
well, our first retirement was in 2005. And then the financial crisis hit when we both went back to work. And then recently re-retired in the end of 2013.
Okay.
So you
So it's
retired. You first retired at 50 and 52.
Correct.
Relatively.
That's young.
And do you have pensions?
No.
Okay.
Okay.
we've been riding this wave of the stock market for good 20 years now.
And how did you guys navigate through the financial crisis? Like, what were some of the investment decisions you made as the markets were going crazy then?
We didn't do a good job of that one, of 2008.
Yeah,
And
tell us about it.
We lost 50% of our portfolio in that crisis. And since then, we learned that we needed to have more cash available to ride out these waves. And that's what we've done for this one. But my feeling is that this is going to be a long downturn, that even if our leaders decide something different, it's going to take a while to build that trust back with these other countries, and that it's going to be a long, slow growth back. So, and I expect that it's going to get far worse before it gets better.
So let me ask a question. So back in 2008,
It's exactly where I was going to go to.
okay, Scott, go.
No, go ahead.
Oh, back in 2008, you said you lost 50% of the portfolio. At one point in time, the portfolio of you were 100% equities was down by about 50%. What did you do at that point in time? How did you react?
So we were actually professionally managed during that.
Okay.
And we basically the professional management managed the portfolio through much of that process. Again, whatever buy and sell processes, it was done by professional managers.
Okay.
And it was, I believe in 2009 was when we basically stopped doing the professional management. We did not.
You went to cash? Did you go to cash?
No, we went very slowly into cash. It wasn't like we sold off a bunch.
You went to cash.
Cash.
Ultimately, you went to cash, though.
We went to again. It was about a 4 to 5 year. How much we would need to be able to last 4 to 5 years in cash.
Okay.
And then the rest we kept. And so where we're at currently, I can give you the numbers.
Fire away.
And by the way, if you tell me today you're 100% stock and you're relying on your portfolio, we would say you need to sell some of your stocks today to have enough cushion. Okay.
Right.
So tell us the account balances and how much income you're taking from them.
Okay. So in my IRA, I have 1.2. And then I have a Roth of 380. My husband is pretty much the same, 1.2 in the IRA and 380 in the Roth. The breakdown is about 63 to 64% in stock, 23% in bonds, and about 13% in cash.
Okay.
We pull out about 110 per year, and that's before taxes. We are
so
currently
it's a little less than 4% of your portfolio.
Yeah.
Correct. Yeah. We collect Social Security of about $5.4K per month. I have a very, very small pension, and my husband has an inherited IRA, and that combined is about $1,000 per month.
How much time is left on the inherited IRA?
The interesting thing is, the thing that's different for me is, in 2008, I had the ability to go back to work.
That's right.
So did my wife.
That's right.
So did Ann. Now we're looking in our 70s. That's going to be a lot harder.
All right. Well, let's.
Right? And we went back to work, by the way, in 2008. So she went. She got it. We both got jobs, and worked for 5 years.
Well, if early 50s is pretty young to retire. So let's think about this, right? Because it's not an all or nothing, Patrick. It's not an all or nothing. It doesn't mean, hey, either we're in or we're out, right? So right now you're at about 65%, and you've got 60% equities, and the rest is bonds and cash.
You've got about a decade to go before you with your withdrawals, and that's even if you increase your withdrawals for inflation before you have to start selling any stocks. 10 years.
You've got a long, long time. So this is part of being a financial advisor. Scott and I have done this for a long, long time. Is managing emotion. That is probably the most difficult part of the portfolio. Is not actually the portfolio itself. It's the client attached to the portfolio. Did that come out wrong?
No.
Behavioral finance. It's it.
So if you were my client, Patrick, I'd acquiesce a little bit. I'd give up 10% of the portfolio in equities just to keep you grounded in the rest, to make you feel good. Because the problem is you You want to feel like you're doing something. Like no one wants to sit in a burning building and think, why am I sitting in this burning building?
Right. That's what it feels like.
I draw the analogy as to, I think we ordered a Lyft to come to our house and pick us up. And what showed up is an Uber, and the driver's drunk.
Okay.
And we can't get out of the car.
Okay, well, we have Ann and Patrick with us now to tell us what has transpired. Welcome, Ann and Patrick.
Hopefully we didn't create too much disharmony in the relationship.
No, not at all.
No, we're still together.
If you step back sometimes and just kind of think of this, it's all kind of just a big game. I mean, like you've been married a long time. You understand how interesting each individual is, and our strengths, our weaknesses, our concerns, and
how we react to things,
our irrationality. I mean, that's just in
a relationship. It's part of what.
So
you've been my business partner for over 30 years, Scott.
I'm 100% rational all the time.
So where did you guys end up? Just kind of fill us in on what you did.
Okay. So what we did is we basically took your advice, Pat. We gave up 10% and moved that into cash. And so now we're sitting at about 53% in stock, 23% in bonds, and about 24% in cash.
And the portfolio value is much higher than when you called.
As the markets are as well. Had you not done that, your portfolio value would be higher today.
It would.
How do you feel about that?
I feel personally that the trade-off was worth it.
Good.
Thank you.
Because since that down portion in the market, our portfolio has still gained over 300,000.
That's right.
And now it could have been more.
Okay.
But the
it could have been less.
Right. Yes, and it could have been less. Absolutely, it could have been less. But the anxiety that I personally would have experienced would have been far greater.
So I'm going to share a quick story because it reminds me, and I use the word acquiesce, right? Which is, look, as an advisor, if the portfolio is structured correctly, which we believe that our portfolios are structured correctly for the client, given the resources that we have and what comes into us. So sometimes they're highly concentrated stock positions that are a little bit harder to build around, but we still do. The idea is to keep the client invested for the long term. So I'm going to share a quick story. When I started years and years ago, I had this portfolio, and inside of it was this little mutual fund, the GT Global Emerging Markets Fund. This
Submerging Markets, which was later renamed.
Which we later renamed. And this guy...
This was like 30 years ago.
This is over 30 years ago, and it made up about 1% of his portfolio. And he came into my office, and I was a relatively new advisor, and you get better at handling clients as you go along. And he came into my office and he said, I've been looking at this portfolio, and this particular holding is terrible. Why is it in here? And I said to him, I'm going to get rid of it. And he said to me, wait, you have no confidence in this? I said, no, I have confidence in my investment selection. I don't want this thing that actually, if it goes up by three times,
it's not going to make any. Such a small piece of the portfolio makes no difference.
It makes no difference. I don't want to spend time or energy discussing with you why it's there, because it really doesn't make that much difference.
You mean to tell me you had a client that came in and looked at the worst performer and wanted to spend time on that and not time on the best performer? That is strange. I've never had that experience.
Amazingly enough. And the point being was I got rid of it because it was distraction to everything else. It was a distraction.
And that's what he was looking at on a daily basis.
And that's what he was focused on. And as I said to him, it could go up by 3 times. It could go up by 5 times. It's not going to change your lifestyle. you going all to cash would have changed your lifestyle,
Yes.
right? So
Yeah.
the thing going forward is don't let this portfolio run. And when we say run, right now your portfolio is no longer 50-50 because you stayed in those equities and we brought it to 50-50. My guess right now is it's probably 57% equities.
She thought 53, but I don't. Did you calculate the numbers recently?
What is it recent?
Yeah,
what is it now?
Yesterday.
Okay, so it's
Yesterday.
53.
So to Pat's point, if your objective is like we're going to have 50% of our retirement savings in equities, then when it starts going up, that means you have to sell a little, and conversely, when things go down, you need to buy a little. So that automatic rebalancing alone will give you quite a bit of extra return.
So on our portfolios,
with reduced risk,
most of our portfolios we screen on a weekly basis to see if they're out of alignment with the models that we want them to be in. Because what we're interested in is a risk-adjusted rate of return. And if you don't have that discipline and do that,
10 years from now you're going to be back to 65%.
yes, which means that the downturn is that much harder.
Or should we be?
So, years ago, back when we were first kind of getting interested in, how to structure portfolios and how the balance should be, it used to be that the advice was when you're younger, in your 40s and 50s, you should be 60% stock, 40% bonds or equivalent. And then when you retire, you should actually do opposite. That you should be 40%.
I don't know. There's also they take 100 minus your age,
which is kind of the same thing. That's what we were taught. That's all garbage. It's all garbage.
Okay.
It's based upon two things: your needs, like how much need do you have from this portfolio. If you don't have to touch any of it, then you can invest however you want. You can bury it in the backyard if you wanted to. If you didn't need this for your income. On the other hand, if you are highly dependent upon this portfolio and you need to generate a certain amount of return to manage your lifestyle, now you're kind of forced to take on some volatility in that. And then the key is, how do we balance the two so you don't go insane, but you still have enough extra return in there to generate what your needs are.
And then you look at it another way, which is I have a 80, I think he's probably 81. I have 80, I think it's 85% of his portfolio is in equities because he's got a big pension coming in. And so it doesn't really, and when we look at the overall, the net present value of the
his
stream
view
of payments,
is it's going to go to his kids or grandkids or whoever.
That's right. So we're managing for something completely different. For you, you're 50-50. And quite frankly, you would be well served to hire a good financial advisor. And the problem is that you had a bad experience with a financial advisor before, and you don't think that they add value.
They're going to add value. They're going to add value in the rebalancing, the way that equities are structured, and frankly, in the fixed income and the cash management side of things.
Right.
Because you fired your advisor in 2009.
It's true.
So you had a bad experience.
Yeah.
So you would be well served.
At a minimum, have a.
Yeah, I wouldn't necessarily blame the financial advisor per se. You know, it was, again, we were like,
well, it's
we were
okay to blame them
into
sometimes.
Retirement, and you know, we've been told, you know, by so many people when we were taking a look at can we retire, can we not? It's like, oh, you're perfectly safe, no problem. And then with that financial crisis, I mean, everything
that was nasty.
That was terrible.
Went south, right? Yeah. I mean, it was that was a pretty horrific experience. And we were, you know, I mean, we were pretty lucky. A lot of people got hurt so much worse.
That's right.
Did, right.
I just over the long term, the cost of a financial advisor to you will be de minimis relative to the value they add, so especially as you age. Especially as you age. I have a meeting this afternoon with children of 85 and 86-year-old clients that have been clients for 30 years. And we're discussing things that are really difficult to discuss.
That's right.
Yeah.
Yep.
Yeah.
But
that
need to be discussed.
What it is. So we appreciate the call. I'm glad you actually won this argument, Ann.
I think this sounds really great. I mean, I'm really happy with this outcome.
Yeah, just make sure don't let that portfolio run on
And
you.
always remember, your goal is not to die with the highest net worth possible.
Right.
That's not your goal. That would be nice, but that's not your objective. Your objective is to maintain your lifestyle and have some peace as the markets do what the markets do.
That's exactly what we're trying to achieve.
Right. Well, good. That's what.
And if you were really good at prognosticate, you would actually figure out how the last check you wrote bounced.
That's what we tell our kids.
Yeah, that's not going to happen. No, it'll never happen.
Yeah.
It'll never happen. So
It won't, I know.
I appreciate the call.
It's been so good having everyone with us today. Enjoyed the program. If you like our show, make sure you give us a good review, rating, or whatever it is. Let your friends know about it. And follow us, so it means you get the thing delivered automatically each week. Anyway, this has been Scott Hansen, Pat McClain, Allworth Financial. We'll see you next week.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.